Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Masterclass. We do this masterclass every week. So myself and my counterpart Taylor Koo here, joins me sometimes. But we do this to help you kind of just learn the ins and outs of passive real estate. Put all this knowledge into action so you can go confidently into your first or next deal. If you haven't done so already, be sure to register at passiveinvestingwithwhitney.com for future masterclass sessions and to check out our open deals and schedule time with myself or the investor relations team. We do have a couple open deals right now, depending on when you're listening to this, but if you're joining us live, end of October, 2022, we do have deals open in car wash and self-storage and multifamily and real estate debt. So pretty much everything except for hotels right now. So be sure to reach out to us if you are ready to pull the trigger and get into your first or next deal. Anyways, I'm going to give it just, we've got kind of a full house already, but we have such an in-depth topic today on how to screen a deal in 15 minutes or less. Taylor and I, we were kind of talking through the agenda yesterday, like what exactly do we want to raise on this call? There's just so much we can talk about. But Taylor and I really landed is that we want to go really high level over how can a new investor or even a seasoned investor, what are the questions they need to ask themselves, to when they get an offering memorandum that lands in their inbox, in order to kind of get to, yes, the next stage of actually doing due diligence. So we're not going to go super deep into all the due diligence questions. There'll be, I'll clue you guys in on the end of the next boot camp that'll tackle just that. But really, what do we need to do in order to, or what questions do investors need to ask themselves when they're looking at an offering memorandum in order to kind of get to that initial yes stage? Like, do I want to spend some time here and actually dig deeper? But Taylor, I had completely forgotten myself. Taylor, who?
Hi, Whitney.
He is one of our awesome members of our investor relations team.
Stop. What do you want from me?
Anyways, Taylor, I'm so happy to have you join me today because for one, this is just such a broad topic for us to be talking about, and two, it can be really kind of dry if I'm just doing this presentation style. So, Taylor, let's kick it off. Like, why do investors need to actually have a screening process? Like, what is the first thing that, why does somebody need like a formal process in place as opposed to just going, hey, I like the pretty pictures in the offering memorandum, let's do this?
As much as the pretty pictures and offering memorandums are great, there's still a lot of work that leads up to trying to screen a deal so quickly. And when you're trying to screen a deal, if you don't necessarily know what you're screening for, it's really difficult to make that decision in that small amount of time. And so, we've talked about this in multiple master classes beforehand, but I feel like one of the most important factors that you need to figure out for yourself is, what are you trying to accomplish when you are investing? What are your investment goals? Are you looking for cash flow? Are you looking for that back end equity? Are you looking for an inflation hedge, tax benefits? Once you at least gain some realization with what you're actually trying to accomplish and what your risk tolerance is, that makes screening these deals so much quicker than if you were to just look at a bunch of deals and have no idea what you're actually really looking for.
I love that, because I always talk about the 7 pillars for building wealth. And the first is, and this is why I think real estate, and I know why real estate performs so much better, from a stability standpoint, consistency standpoint, than stocks, bonds, and mutual funds, is because it does, if you have your goals outlined, if you are checking the boxes on all 7 pillars, you have multiple ways that you can make money in real estate. So kind of like what you said, Taylor, you got capital preservation, cash flow, equity, tax benefits? Do you need tax benefits? We're at the end, we're in Q4 right now, and there are a lot of investors that you and I have been talking to that are scrambling for end of year tax benefits. Do you need some sort of inflation hedge, asset that hedges inflation in your portfolio? Do you need to be able to, arbitrage the interest rate environment better, and how do you do that safely, especially, with all these grumblings of recession and inflation, and we've got the Fed, consistently raising interest rates. So I guess I love what you said there. Start with your goals, start with your risk tolerance. So this kind of like, once we kind of, somebody, gets those boxes checked, I think that really helps them, narrow down the type of operators they should be talking to, right? You don't just join everybody.
Absolutely.
Otherwise I've made this mistake before where I've joined a ton of operators lists, some of which I'm not matched with as far as like, them helping me make my goals, or maybe they're outside my risk tolerance. And now I just got a box full of emails and I don't do anything. So that kind of leads us into the first step of our screening process is the operator. So what are some of the things from a high level that an investor needs to be thinking about as they're, figuring out who they're going to do business with, right? They're a limited partner. They're looking for a general partner. They're partnerships, right? You guys are going to be doing one deal or multiple deals for 5 to 7 years, right? So what are some of these things from a high level that investors need to be thinking about?
Yeah. So when you come to finding and vetting these operators, and I hope that when you receive a deal and you're vetting this deal for the first time, this also isn't your first interaction with the operator either. At this point, you should already have had a conversation with the operator just to see if it aligns. And I feel like this is one of the most important steps too, is, like Whitney said, it's almost like it's a long-term partnership. It's a marriage. The nature of these syndications are typically underwritten for 5 years, could be a little bit longer, could be a little bit less depending on the asset class. But you have to trust the partner that you're going to be investing in. And so figuring out what is their background in business, who is on their team and what are their roles. Are the GPs co-investing alongside the LPs, or have they experienced? Whoa.
Oh, you gotta go?
No. I think that was an Amber Alerts. There is an endangered adults. Sorry about that.
I mean, you're in the Bay Area. I was like, oh, you gotta go.
Yeah, well, no. Everything's good. I mean, it was on silent too. But that came out of nowhere. Well, and also there's just an earthquake here as well. And so it was like a 5.1, but I'm good. Anyways, back to what I'm cool. Anyways, back to what we were talking about. We're talking about how these operators are taking on challenges, what their idea of an outlook on the current market is. All these questions should be asked up front before you even invest in a deal. Or and even look at a deal.
Yeah, guys, Dan Hanford, one of our managing partners, wrote an amazing article called "The 7 Red Flags for Vetting Operators." And this isn't so much an article about how to vet an operator, but what are some of the flags that if you see in these conversations, in their materials, in their marketing, that you should dig deeper on and ask further questions. But Taylor, one of the things I really love that you pulled out, and thanks Taylor for dropping that link in the chat box, is this, we talk about how to screen a deal in less than 15 minutes. And the first 2 things that we're actually talking about are the work that you should have already done, right? Setting those goals, understanding your risk, and actually having this conversation with the operator. Because once that deal comes out, and I know for me, I've experienced this as, when I was working as the director of investor relations, you have a deal come out and then all these investors you've never talked to before are cramming the calendar because they love the deal and they want to have the conversation with you. That's actually the wrong time to be having the conversation. So I encourage you, right now, if you are listening to this and you haven't jumped on a phone call with us, if you like our deals at passiveinvesting.com, or an operator that you're following, if you haven't already jumped on that call with them, do that now. That way, whenever the deal does come out, you can move quickly and you have these questions answered.
I also want to throw in just a key tip in there as well, as you're talking to other operators too, and especially, and this is just so before I don't forget about this key tip, is when you are finding an operator that you do like, typically they're also going to invest with other operators that they like as well. And so asking the GP who else they're also investing in as an LP, I think is a huge golden nugget that I wish more LPs would ask and also know.
Yeah,
there are a lot of great
absolutely.
operators out there.
Yeah, because I mean, myself, a lot of our team here at Passive Investing, we invest in our deals here, but we also because think about it. What can a limited partner do? They can diversify their operator, their market, and their deal. Okay, past that, they're giving up day-to-day control of the asset in order to get their time back and create that massive leverage, within their own passive business and scale their portfolio. And so other operators are doing the exact same thing because they only have so much time and capital they can put in their business. And so they want to diversify their portfolio too. So I think that's a great point. Another point I want to bring up, and this is something that I really appreciate, Andrew, our Director of Investor Relations, always, brings up, is point blank asking that operator, hey, have you ever done a capital call? Have you ever suspended distributions? Have you ever needed to rework the distribution calendar on an asset? And it's that last question that I really like, that helps you kind of dig in, because how does an operator, what is their business philosophy? What is their business strategy? What is their transparency around how they've had to be able to respond to different economic environments? I know most people, or a lot of operators that are operating right now, may not have been through 2007, 8, 9. They've all gone through, almost all of them have gone through the pandemic. So really what you're trying to do, you're not looking for the operator that has 100% glowing record. You want to actually dig in to figure out how they've responded to different economic environments. If they're an operator in Texas, how did they handle the collapse of the power grid back in 2021? If they're an operator in Florida, like how do they handle hurricane season and stuff like that? How do they handle communications? But those are all things that need to happen, initially in that conversation. And guys, I will drop in a link to the Passive Investing Made Simple playbook that I wrote that actually goes deep into how to vet operators, markets, and deals, and those 7 steps you need to take before you get into your first investment. All right, so Taylor, we've talked a little bit about the operator. Now, okay, we've got the deal hitting our inbox and we're getting into that screening process. This is making the assumption that the limited partners already hopped on the phone with that operator. What is the next thing that they need to do in order to screen that deal at a high level?
Well, and this is also going a little bit hand in hand with the first one in terms of vetting the operator too, because next we're going to go into the actual market that these GPs are investing in. And if you like the markets that you're investing in, oh, just got something pulled in. Oh, interesting that you can't see that. We'll work on that in the chat section. But yeah, do you support the markets that they're investing in? Are you looking for that with markets with strong market fundamentals that has a strong population growth, has a strong diversification of employers, are landlord-friendly states? Is there crime within the area? What does the income look like within those sub-markets that they're investing in? All these questions, and trying to stack as many of your investing cards as possible within as many as in your favor. You got a little tongue-tied there.
That's what I always say. How many investing cards can you stack in your favor, right? Because real estate is illiquid, right? Businesses, even if you're going into say like a passive investment that invests in a business, it's generally illiquid. And so you're, especially if you have a brick and mortar location, a multifamily building, self-storage, car wash, you can't just pick it up and move it. So you need to make sure that you're in, you're in that MSA that's already poised and ready to perform. Not only that, you're in the submarket in the MSA that's poised and ready to perform. And possibly, like if you're in, a business like self-storage or car washes, you're on the right corner in the submarket that's in the MSA that's poised and ready to perform. So you're in that path of progress. We love looking for those, starting with those business friendly locations. And we look for states that have good tax laws, have good landlord tenant laws. But those are just a few of the things that, at a high level that, any investor should be looking at, regardless if you're investing in a passive investment or not. If you're investing in real estate, you want to make sure that you're looking at those pillars. All right.
Well said.
I've got too many windows open. Okay, so we talked about the market, and really, you want to deep dive in the market. Not all of us are experts at sussing out those details. I mean, like for me, I come from a research background. Those are the things that I love doing. Even a quick glance on. You're going to get market information in the offering memorandum. That's fantastic. But remember, the offering memorandum is a marketing package, right? And so, you want to make sure that the operator is giving a comprehensive view of the market and not just kind of cherry picking the stats they want you to see. So it's really important for you before you invest in any location, go do a quick due diligence on your own. You can go to a website. I love using niche.com, NICHE.com. Type in the market. You can look at the businesses, the schools, the crime, the poverty, city-data.com. That's another great place to go look. If you're somebody who is really great at data, you can go to the census, government census website. They're constantly revamping how they're formatting that data. It's kind of a pain to pull it. But that's really probably where most of those data sets are hosted.
There's also one more I want to throw in there as well. Neighborhood Scout is also a great one. It is paid, but they have a lot of just great information from the crime, the income, and they bring it down to the submarket level too. So it's not as large. It's very focused on just at least the smaller markets.
Yeah, and keep in mind these data sets that we're talking about, they probably all pull from, probably from government data, local city government data, state data, as well as federal data. And those data sets generally run about 2 years in arrears. So how do you get at the forward-looking data? And this is where you can ask the operator, and this is after you review their marketing, information, and they should be doing webinars on the different investments and the location. But you can also ask for CoStar reports if there's something in there that's just looking a little bit unaligned, because they're going to have access to those type of databases that are going to give forward-looking projections on different markets and areas. All right, the third piece, my favorite, because I'm such a junkie for spreadsheets, is looking at the deal. Now, Taylor and I were kind of talking about, we're like, how far down do we want to go down into deal screening? Because when I showed him my deal screening checklist, and he was like, Whitney, come on.
15 minutes. I mean, maybe a little bit longer, but I don't know about 15 minutes from the deal spreadsheet. But I mean, it was a great spreadsheet though, because it really, I mean, you had a case by case scenario between what you were looking for, and it was very clear in what your criteria was.
So I'm going to reward everybody that's here listening to us live, as well as those people who are listening in the next few days. I'm going to be doing a deep dive deals vetting webinar, like deep dive. We're going to deep dive into setting up. Well, let me just put it this way. This whole boot camp is going to be around you building the exact same spreadsheet for yourself for the deals that you want to see and the goals that you have. Okay. And that webinar is going to be November 4th at 10:30 a.m. Mountain Time, 12:30 p.m. Eastern Time. It'll go about an hour and a half. If you register for it, so look for it in your email box, you'll have the chance to either attend live or watch the recording. But the whole point of that boot camp is going to be so you can build your own deal screening spreadsheet, much like what I have. But let's talk about some of these high level things that should go on anybody's screening. What should an investor be looking for at a very high level? And again, not so much to say I've completed my due diligence, but where they can get to yes, and maybe set aside that extra hour or two that they need to for due diligence.
Yeah, I mean, there's in this list, I feel like does change across different investors depending on what they're looking for, but a lot of it goes at least past the return, just the return metrics. I mean, something that I look at is not only the return metrics, but I also look if there are performance-based hurdles in there, meaning that in order for the general partners to get compensated, like a preferred return, the passive investors need to get compensated first before the general partners can participate in the cash flows. I take a look at the debt terms, especially right now as interest rates are still continuing to rise. What type of debt do they have, and how leveraged are they on that debt? Are they using bridge debt where it's a floating rate, or are they using fixed rate debt? I would take a look at the hold period, how long they're planning on holding that asset, and how long the investment opportunities is. And my mind is blanking here. Whitney, do you want to add any other additional ones that you can think of off the top of your head? Because I do have a couple others, but I want to, that's a little bit more of a deep dive.
Yeah, so I mean, for me, the way I kind of break it up, and then this will give guys kind of like a understanding how I orient to it. Like the screening process, you want to double check the market, right? Like when you get this deal, first of all, is it what you're looking for? Like, if does it align to your goals? Is it a multifamily self-storage car wash deal? Does it, is it an market that you've been eyeing for that's poised for growth, right? Make sure that, because let's just say like you're looking for a multifamily deal and you're looking in growth areas and it's coming from, I don't know, like Greeley, Colorado. And you've never even thought about Greeley, Colorado, that might not be the time to start digging into the market, right? Greeley, Colorado is growing, but it's not a primary metropolitan service area. So there's some misalignment there. So make sure, go ahead and stick to your guns around, like, does it actually meet your goals? Does it have the unit count and scalability that you're wanting to see? If it's a multifamily deal, and you said, I'm only going to look at multifamily deals that are over 150 units, and this multifamily deal is at 75, don't change your criteria to make it work. Stick to your criteria. Does it have your whole time that you're looking for? Are you looking to, cycle your money right now? Andrew did an amazing town hall last week and really helped investors orient to longer timelines. We're putting debt on properties so we can be prepared to hold 5 to 7 years. If we can reposition in 3 and continue to accelerate velocity with money, yeah, we're going to do it. But if we can't, we have the flexibility with the debt to hold longer. And then, then you can start getting, is it one more thing, the class of property that you want to see. I know so many people that are chasing yield right now, but they're not looking at the risk they're taking on with the various class of properties that they're going into. And that's very important. Not only from an immediate risk standpoint, but also long-term on the exit. So, take a look at, kind of sticking to your criteria around the class of the property. And then you can get into the return profile on the property and lining up what business risks are being taken in order to achieve those returns. But, those are just, again, just kind of the screening part. And then like what I'm going to help people orient to is how do you get to those deeper due diligence levels, digging into, the numbers, digging into the returns, digging into the business plan, but just at a very high level. And the last piece that I want people to orient around is the distribution schedule. I just attended the Left Field Investors Meetup last Friday, and in Columbus, Ohio. Such an amazing event. So thankful to have been invited to that event and to speak at that event. But I was talking to, a lot of investors, and they were frustrated because they can go into assets, that, might, hit their yield parameters, and they only distribute quarterly. And it was hard for them because they're like, what, how do I orient to that in order to be able to pay my bills if I want to create passive income and, unlock my golden handcuffs? So, make sure that the deal actually distributes to the schedule that you need it to. If you're still working a W-2 job and quarterly schedules, or if you're investing through a retirement account, quarterly schedules might be fine for you right now. But if it's for somebody that, if you're an investor who's trying to live off your passive income, I would maybe think that you might need monthly income. So, just make sure those, and distribution schedules, I'm bouncing all over the place because I'm really excited and passionate about this topic. It's like, oh, one more idea. Oh, let me give you one more idea. But, that distribution schedule, I don't think people really put that much emphasis on that in lieu of returns. And for me, the distribution schedule actually is an indication of how solidly somebody is looking at their business, the operator looking at the business and managing the business. Are they managing it on a weekly, monthly basis, or are they managing it more on a quarterly basis? And so for me, it's actually kind of not so much like a need for me, but an indication of that global operator's ability to manage the business. So do you have anything else to add to that?
Well, one thing I do want to add that gets brought up every now and then, I'd love to get your opinion on this as well, is do you think fees impact also your screening of a deal in 15 minutes or so, whether they're too high or too low? What influences you to make the decision?
Well, sometimes I do include fees on my due diligence. And there's two ways to get out of it, because not every operator actually puts the fees in the offering memorandum, and that's for a variety of reasons. Because remember, the offering memorandum actually has to be written in at a point in time during the general partner's due diligence phase, and they might not actually have everything solidified. Right? Debt terms typically don't get settled out until about 2 weeks before close, but the general partner needs to get that deal out probably 4 to 6 weeks before close at a minimum. So there's still a lot of moving parts. And so what goes on that offering memorandum are really those key points that the general partner has fairly well set. And so, so kind of looping back to fees, those fee schedules might still be getting, solidified on the underwriting, as you move through the debt terms. I like talking with my hands. That's why
No, I got you. I got you.
But that's something that you can get at, right? Like a general partner generally has kind of a methodology that they follow. They typically don't, at least for us, we don't change it too often, but other operators I talk to, they don't change it terribly often on their deal structures. So you can actually get at that high level fee structure in that initial conversation with the operator. However, always, before you cut a check, before you sign on the dotted line for that legal, PPM, you're going to want to get clarity on what those fees are, and they should be outlined in the PPM.
Yeah, and another key question that I think is really important to ask too, and maybe this isn't in the 15-minute screening portion of it, but afterwards in the follow-up call, let's say with that general partner, is how and when are these fees taken out? And so, acquisition fee can be taken out on the front end. Asset management fee, it can be taken out of the equity raised and taken out annually. But the caveat to that one, though, and a good question to ask is, if distributions are paused, are those fees still being taken out? And if they are taken out, that's kind of a red flag. Like if they pause distributions and they're still taking out your fees, that could be a red flag. The disposition fee, when there's a capital event, The capital event fee, is that performance based? Is that fee taken out if you as the investor reaches a certain percentage IRR? So some things to look out for, maybe not in the initial screening process, but maybe in that follow-up as you do a deep dive, if everything hits your parameters or what you're looking for.
Yeah, and I think, in general, what you're trying to dig at there, Taylor, and correct me if I'm wrong, you're trying to check for alignment. Are
Absolutely.
the limited partner and the general partner aligned on a deal? And or are, is the general partner just kind of being the deal to death? And I haven't, this brings up two things for me. One, I have a great video on that breaks down all the different fees that could be charged to especially a multifamily deal, but this would apply to nearly any type of private investment. Now you guys can reach out to me directly and we can send you the link to that video. You can also find it on our YouTube page. And we should do a deeper webinar on that because, especially in today's environment, that's people are trying to figure out how businesses are operating. And I love the fact, right? We've been in an amazing ride going up and now we're in this choppy water environment. And I feel like investors are becoming more and more savvy and asking these technical questions. And it's amazing. I love seeing that kind of evolution in the thought process from a limited partner investor. So, all right, Taylor, you wanted to take a deep dive on a deal and kind of put the screening to test. Are you ready?
Oh yeah. Oh, it's putting me on the spot. Yeah, let's do it.
Yeah. Well, hey, I get to do this all day long. No, I'm just kidding. So
you actually do this all day long, not even with our deals, but also other people's deals too. You're screening deals left and right.
All right. So let's kind of run through these questions. Taylor, I will kind of check them off. And you had an example that you wanted to go through.
Oh yeah. You want to use Banks of Bridgewater?
Yeah.
What we're doing right now. Cool. Let me actually pull it up real quick.
And I know some of you guys, we're going to leave plenty of time for the Q&A for those people who are joining live. And if you have never joined us for one of our webinars before, we have what we call the after party. And so it's seriously an Ask Me Anything section. So be sure to stay tuned for that. Some of the questions that are coming in don't necessarily apply to our topic at hand. So we'll be sure to ask those in that Ask Me Anything section. But Taylor, if you're ready, I feel like we don't necessarily have to go through vetting the operator at this particular time, but
because we're the operator.
I don't know. Because the operator on Banks at Bridgewater is us. So
is us, yeah.
Yeah. So
it's a live deal. Yeah. Understandable. Yeah. So we already got through the whole trusting phase and we're in our track record and how we respond to challenges.
Yes. So, but I do think it's really key that we kind of set the parameter around, as we're kind of going through this checklist, what type of investor's eyes are we looking through? Who's this investor profile and what are their goals?
That's a good question. Let's say, do we want the investor to invest in the deal or do we not want the investor to not invest in the deal is a good question. Maybe we do both.
Well, yeah. Well, so, okay, let's look at it through an investor that is still in the accumulation phase of their investing career. They're still, working their W-2 job and they need a safe place to put money to grow capital right now. And they're not really willing to take on many risks.
A lot of risks.
A lot of risks to do that.
But then they're also looking still for that supplemental income then. Right.
They need a little bit of income. They want to build towards that. They also need to continue to, march forth on that accumulation phase.
Okay.
So let's take a look. So the first thing, kind of check the operator box, for those of you who don't know us, we have 1.3 billion under management, 3,300 self-storage or multifamily, 6,600 self-storage, 26% LP IRR, 56% increase in valuation in under 3 years on our exited assets. Okay, we checked that box.
Okay, we checked that box. Yes.
Okay. So, now let's talk about this. So we talked about the market. Is
Well,
this particular market, the assets in, is the population growing, the jobs growing, jobs diversified, incomes growing, household income? What is the market? Does it hit these parameters?
yeah, so Myrtle Beach, South Carolina, it actually is one of the fastest growing cities. It's in the within the mid coastal southeast section of the nation, and so it actually has seen 40% population growth since 2015. Now, if you know Myrtle Beach, people typically say that, oh, it's really just a retiree community because you're looking at just the different industries. But you also take a look at, I mean, we can even go through the actual offering memorandum to take a look
Yeah,
at.
let's because I want people to understand that they can literally have this OM hit their box and they can get to a high level. Yes, I'm going to dig deeper.
Right. And so if we pull up here, actually, no, this is, that's not the one I was trying to look at. This is the one I was trying to look at because that was the additional one. So in this marketing, you can see the population growth, at least compared to some of the other mid coastal cities.
Oh, we're still looking at your spreadsheet, your beautiful spreadsheet.
You see my spreadsheet right now?
Yeah. But
You mean you're not seeing the OM?
no, we're seeing a spreadsheet.
Huh. I thought I was sharing with you the OM the entire time. Okay, here. How about now? Can you see that?
Yes. Woohoo! Okay,
Oh my gosh. I was scrolling thinking everybody could see it. Oh geez. Okay. No, so this is Banks of Bridgewater, Myrtle Beach in South Carolina. You see that the population growth is really strong, as well as the rental growth being really strong. It's outperforming the other strong mid-coastal cities over in the southeast. You can see the comparison between the growth behind the other cities within the southeast. Another thing that I really enjoy too, the actual demographics of the city. That's not just a bunch of service industry. There is still the university. There is the hospital that's right across the way. It's just a strong diversified market that's not just reliant on one industry.
All right. And so you kind of given us a tour of like how to pull out those data points around population, jobs, and job diversity. What about income and housing? Like,
yeah, income and housing. That is a good question. And this is hold on, where is it? That's not it. Where's the comps? Where's the comps?
well, and I think those are, while you're kind of searching for that, those are great, income points, or excuse me, data points to look at too, are the comps, right? At a high level, is the subject property you're looking at, are there still other comps in the area from a sales perspective, as well as from a rental perspective, that perform higher than the subject property? Because that also gives an indication that that subject property still has room to grow. Or conversely, you can look at it, it has room to adjust its business plan if it needs to become more competitive in the market. So I think that is two ways to kind of, orient to that data.
Yeah, I mean, as you can see here, I mean, you can take a look at the comps, see with the 1 beds, 2 beds, and 3 beds. They're not, I mean, there is some room for growth, as you can see, and compared to some of the comps within the area. In terms of rent comps, and then you can even take a look at the sales comps here as well. But one thing I also want to point out, here's the sales comps, you can see. But one thing I also want to point out is this, especially within our offering memorandum, is the sensitivity analysis, what that break-even occupancy looks like in terms of our gross income and our expenses here on the right side.
And I think that should be bumped up. I usually have sensitivity analysis pulled down into deeper level due diligence, but even right now in this environment, I would maybe pull that to screening data point. All right, so let's talk about it. So we screen for the market. So, on a high level, the market looks good. How can we start looking at two different data points, the returns and the debt? Like, where are we going to find those in an operating memorandum?
In the offering memorandum, you can find the debt here, page 39. You can see how much our loan to value is, type of loan, if it is fixed or not, and then the term, and then also the interest rate.
Awesome. And I love the fact that you kind of touched on that you want to see fixed rate debt right now.
Especially right now.
Especially right now. Or if, an operator does have to use some sort of construction loan or, variable interest rate debt, that this is, that there's a cap, right? And that they've underwritten to the cap, right? And that the debt is at least for the term of the business plan, if not longer. All right. So
and then for returns, right over here, page 15. And this is where you can also see the sensitivity analysis as well. And this is something that I'd like to look through, is looking at where that entry cap rate is, and then also what their exit cap rate is. And I think there's a nice, I guess sensitivity analysis behind if cap rates expand or if they compress.
Mm-hmm. Awesome. And, this deal isn't going to be for everybody, right? It's going to be for those people that are, or for a certain investor profile. While we think it's an amazing deal and everybody should have it in their portfolio, this is why it's so important that you as an investor have your goals established and your screening process established, so you can actually rule in, rule out in a very quick time period. Does it work for me or not?
So if we're going to culminate all of this into, and if I was just to take an investor perspective and just overall put a summary to what my thoughts are about this deal. I mean, number one, first thing, at least the first thought that came to mind is the fact that this was in Myrtle Beach and it's on a coastal city, and we just had Hurricane Ian. I would just at least want to make sure how other assets are doing within the Southeast, like for us, how we've responded and if there's been any damage and what we're doing to hedge against that. Luckily, this asset didn't get damaged at all. And the only, one of our team members went over to visit the asset, able to just rake off some leaves, and then that was it. But the other thing that I really like is the fact that this is a newer developed asset. It's attracting more of a higher quality resident, that's more stable resident per se. And I really like the fact that it's fixed rate as well, fixed rate debt, especially during these times. And so at least just like from a quick high level with the market, the debt terms, and then, the fact that these are also monthly distributions, I think it hits for me, if I'm still looking to be conservative, it focuses on capital preservation. It's got the tax benefits, it's got the cash flow, and it's got the equity at the end. There's still some leverage, and I like the leverage portion of it.
Awesome. All right, so guys, I just want to, I want to make sure we get to the after party and get people's questions answered. But as you can see here, we just took everything that Taylor and I just talked about for about a half an hour. And then when Taylor went through how you can just pull these data points out of an offering memorandum to give it a high level screening. And again, this isn't due diligence, but just how, to give that first pass, like, do I want to dig further? And just how simple this process can be. And again, I want to make sure that you guys are well armed to be able to put this type of a process together for yourself. So I invite you to attend that boot camp on November 4th at 10:30 a.m. Mountain Time, 12:30 p.m. Eastern Time. And the reason why it's so important to do this is that great deals go so fast. And so, again, all you need to do in that initial screening period is just get to that high level yes. That way you can put your name in on a soft commitment or soft reserve, and then you get to do you'll have a couple of weeks to dig in and do all the due diligence on it. All right, guys, thank you so much for joining me today. Taylor, thank you for helping us kind of put this information into action. You guys make sure to go to passiveinvestingwithwhitney.com for future masterclass sessions and to check out our open deals. We're about to start our
and also too, wait, one last thing. This is also starting to be released in podcast format. So I mean, I don't know how many episodes we are back, but if you have Apple, Spotify, wherever you listen to your podcast, you can also listen to the audio there.
Excellent. Guys, thanks so much
Cool.
for joining. We're going to start our after party now.